The US dollar has faced some pressure recently, but is this just a temporary dip? With shifting economic policies, Federal Reserve decisions, and global market trends, there are potential factors that could push the dollar higher. If you're trading Forex, this is something to keep an eye on. US tariffs, a game changer for Forex. One of the biggest potential catalysts for the dollar is trade policy. While markets have grown skeptical for a new tariff threats, we believe the US will follow through, especially with tariffs targeting the EU and Asia. But this time is not just about short-term politics. A more structured, treasury-led policy could reshape global trade flows. If that happens, the dollar stands to gain while European and Asia currencies may weaken under the pressure of increased trade barriers. The Federal Reserve and interest rate policy. The Fed plays a crucial role in determining where the dollar moves next. After the election, markets initially expected that pro-growth tax cuts, combined with potential inflation boosting tariffs, will limit the Fed's ability to cut rates. However, recent weaker economic data has sparked concerns that aggressive fiscal tightening and higher tariffs could slow consumer spending, especially for lower-income households. As a result, the Fed may have to step in to provide more support. That said, the job market remains strong and inflation is still running too hot for the Fed to rush into rate cuts. So, we expect no cut before late summer, but there is a strong case for rate reduction in September and December, with a possible third cut in March next year. Even then, the Fed's policy rate will still be around 3.5 to 3.75%, well above the long-term target of 3%, meaning the dollar could still maintain strength. Last but not least, geopolitics and market sentiment. Another key factor is geopolitics. Many traders are betting on a Russia-Ukraine peace deal, which has slightly weakened the dollar. But even if that happens, the bigger concern is rising economic friction between the US and Europe. Meanwhile, the European economy is struggling, and the European Central Bank is likely to keep cutting rates, possibly down to 2%. This creates additional downside risk for the euro, and we wouldn't be surprised if euro-dollar trends towards parity by year-end. Meanwhile, the pound faces its own set of challenges, with fiscal uncertainty and potential Bank of England rate cuts pushing pound-dollar towards the low of 120. Commodity-linked currencies could also weaken as global tariffs risk resurface. Let's summarize. New US tariffs could drive a dollar rally while weighing on the euro and Asia currencies. The Fed isn't in a rush to cut rates, keeping support under the dollar. Geopolitical tension and weak European growth add to the dollar's strength. So, where does this leave market participants? The dollar's recent dip might not last, and major currencies like the euro and pound could face more downside. But it's not just Forex. Crypto markets are also reacting to shifting Fed policies and dollar strength. If the dollar keeps rising, risk assets like Bitcoin and altcoins could face headwinds. If you trade Forex or crypto, now is the time to stay informed and ahead of market trends. Hit subscribe for more market insights and drop a comment below. Where do you see the dollar, Forex pairs, or even Bitcoin heading next?